Hello and welcome to The Upside. I'm Kyle Sharapita. February has been a busy month with some volatility in the markets, looming tariffs from our neighbors down south, and the upcoming changes to the political landscape here in Canada. So today, we're going to be diving into the top market stories, surprises, and what should be on your investing radar in the near future. Shortly, I'll be joined by Andrew Hall and Bobby Reynolds, equity research analysts within Fidelity Canada Investment Management, to discuss the tariff threat, including the automotive industry, and what we as consumers are all seeing on the ground in grocery stores, including the Buy Canadian trend. So grab a bag of Miss Vicky's chips and enjoy the show. Today, we'll be looking at highlights from our Fidelity Connects webcast, which is live daily for financial advisors, but then available for all on replay as a video podcast. To start off, we'll hear from portfolio manager David Wolf, speaking to host Pamela Ritchie, who shares what his team is doing, and more importantly, is not doing right now, while managing $100 billion on behalf of Canadian investors. David also reflects on the success of the Fidelity Managed Portfolio suite of products, passing $50 billion in assets managed. Take a look.
You know, we never take that trust for granted. So that's an awesome responsibility. So just
yes, it really is.
In the managed portfolios, it's over 600,000 individual investors in Canada that are involved in these funds. And we feel that every day. You know what, it's a great motivator, at least I'll speak for myself. So, you know, I'm involved in these funds. My son is, my ex-wife is, which she's a proof point, I guess you could say.
Yes.
But no, overall, I mean, I know that if I do my job well, then there are 600,000 people in Canada that have more resources for their families, for retirement, to send their kids to school, what have you. And you know, that's really meaningful. And as you know, I used to be a public servant at the Bank of Canada.
Yes.
And that public service was, you know, really lent a lot of meaning to my job. And I think that there's part of it that is still here as a PM at Fidelity to say, if I do my job well, that's good for an awful lot of people, and that, you know, is one of the biggest things that gets me up every morning and in front of my screens with a cup of coffee way too early.
That's wonderful. Yeah, way too early. Well, but it's fascinating to see what's happened. It's a lifelong love of the markets, clearly, is what you have here. Now, speaking of these markets, it is a remarkable moment. I mean, how do you, when you wake up with your cup of coffee and take a look at all the screens, digest some of the truly massive pieces that are moving around in the economy? There's sort of birthing pangs of what seems like a new economy being built. What do you do with all of this?
Yeah, it is a remarkable environment and one that I don't think anyone alive has ever seen. But I mean, that doesn't absolve us of the responsibility to invest responsibly and take the world as we have it and try to make the best of it for our investors. So maybe a few comments. So first, you know, a couple of things that we're not doing. One, we're not panicking. I can understand the temptation, and a lot of, you know, folks I talk to, advisors and others, like, am I not supposed to just buy a bunch of cash or buy gold and, you know, hide from all of this? And, you know, I can understand the temptation to do that, but that's almost always the wrong thing to do. Yeah. So we're not panicking, we're not hiding under a rock, we're taking the world as we find it. The other thing we're not doing is reacting to every headline, and there are a lot of them.
There sure
you
are.
get, you know, tariffs are going on and markets move. Oh, they're not. Oh, they are. Or they're not. I mean, you know, you can get whipped around pretty good if you try to react to all that. We don't do that. You know, we never do that. And particularly in this environment, we see that as noise. If it's going to affect the markets a year from now, we'll act on it. If it's going to affect the market for an hour or a day, we're not going to react to that.
All right, so I'm joined now by Andrew Hall and Bobby Reynolds, who are both equity research analysts. And guys, thank you both for joining me.
Thanks, Kyle.
Thank you. So we just saw a clip from David Wolf speaking about how his team is not panicking, you know, and not reacting to every headline. Now, David is part of the global asset allocation team. They're part of FMR, Fidelity US, whereas your group is Fidelity Canada Investment Management, who is a distinctly different team. But I imagine you share a similar mind frame of, you know, approaching the markets and headlines rationally. So before we get into your specific sectors, could we just touch on what your teams have been seeing in the past few months?
So as a bottoms-up equity analyst, our job is to look at all of the securities in Canada in our relevant sectors. So I cover Canadian industrials, and with all of the tariff headlines over the last few months, my job is to understand what's the potential earnings impact, both in the near term and the longer term. If you get 25% tariffs, if you don't, if there's something different, what's the impact of just this period of uncertainty? Because there is some impact to consumer confidence and business confidence. And so it's really assessing from a bottoms up perspective what could happen to the earnings of these companies to help us better assess where there might be opportunities or risks that we want to avoid.
Okay, that's good to know. And let's dive a little bit deeper into the sectors that you cover, which, Bobby, for you is industrials, as you just mentioned, and automotive, and then Andrew, consumer staples and utilities.
That's right.
That's right. Okay. So, Andrew, you had a great bit last month in your clip with us about grocery prices. But I do want to turn to Bobby first to talk about automotive, because one of the big topics, one of the big stories, headlines that we had this month was President Trump threatening tariffs on Canadian cars. Now, what does that actually mean? Because I know that there are plants in Canada for U.S. companies. I drove past the Oakville Ford plant on my way in this morning. But what does it actually mean, tariffs on Canadian cars?
So, I presume he's talking about cars assembled in Canada, which would actually have a lot of parts content from the US and Mexico. But perhaps larger for the Canadian industry is the parts that we make in Canada and would move cross-border into the US. And so these tariffs on the automotive supply chain, the feedback I get from the management teams I speak to is they're almost so bad that they can't envision a scenario where they happen and the industry doesn't just shut down. So that's the general rhetoric that we've heard from the management teams in the industry. Now, it's what Trump wants is final assembly to move more into the US from Canada. Okay. There might be areas where companies can do that around the margin. There have been anecdotal examples of a Stellantis plant or a Ford plant that are currently shut from retooling. Maybe they try to move some of that into the US, but to actually wholesale move a lot of the production out of Canada or out of Mexico would be very difficult and take years and billions of dollars and unlikely to be practical, but that's sort of how the industry's thinking about it.
Okay. So there are quite a few plants both in Canada and Mexico, correct?
Yeah, that's right. I think Canada produces around 2 million vehicles and Mexico's over 3, and they're a large source of vehicles for the US market. And so it's not just the assembly, though, it's the plants in the US that could shut down if you get these tariffs, because those car producers don't want to pay the tariff on parts coming from Canada and Mexico that they can't source elsewhere.
Right. And then do you think if that, say, was to happen, would the end consumer in the US end up paying more?
Yes. That's almost a certainty if you get the 25% tariffs.
All right. Good to know. Now, Andrew, turn it over to you. Consumer staples. What have you been seeing in the last few weeks?
So I think that it's still that kind of cautious consumer environment that we've been seeing, irrespective of the tariffs. The inflationary impacts we've seen over the past few years, obviously the impacts of the Canadian economy from rising rates and rising unemployment. And so you're still seeing that kind of consistent caution, and the tariffs might have been an additional impact on top of that.
Right.
But I think more specifically, one of the unique things that we're seeing, I think all of us when we were watching last week, the hockey game, the Four Nations, that there was something extra going on, right? And so I think what we're trying to, in the discovery phase of, is anecdotally there's sort of this buy Canadian movement, which could on the margin impact sort of some of the retailers. But I think we're still in that anecdotal phase versus understanding exactly how big it is. Mm-hmm. But even one of the large grocers last week on their earnings call talked about making it easier for Canadians to recognize sort of buy Canadian products, because I think they're all seeing that. I read the flyers every week. I'm sure a lot of shoppers around here do too, that they're really emphasizing that because I think they're responding to some level of consumer interest in it. Mm-hmm. How long that lasts, I think ultimately the bigger picture in consumer finance is around rates and sort of disposable incomes will drive consumer behavior more so than some of these headline items. But I do think on the margin, it's something that we're watching.
Interesting. Yeah, I think we've all seen the pictures floating around online of like the BC liquor stores took all the U.S. wines off their shelf. There was shelves of apples from somewhere in the States that were remaining fully stocked. It's been truly remarkable to watch. And kind of moving on from here, it's late February now. We're potentially getting some more news next week in the States. Where do you think things could go over the next few weeks for the Canadian consumer?
I think, obviously over the next few weeks, we try to take a longer time horizon than that. So certainly, our focus is on sort of the big picture items around interest rates, disposable incomes, unemployment, and how those sort of factor in, and as well the inflation impact specifically for myself on food. And I think what we're seeing is the Canadian dollar's come up a little bit, and so that might help reduce some of the inflationary pressures that we were talking about in the last video around, obviously when the Canadian dollar is weaker, we import a good chunk of our food, especially in the winter months. And so that could be a challenge, but that should be receding a little bit versus getting more impactful. But I think as we move sort of beyond that, what we're really going to try to understand is the cumulative impact from rate cuts relative to maybe more mortgage renewals, and how that may or may not make it a little bit tougher for Canadians to continue spending at a high level.
Right. And we do have another Bank of Canada announcement coming up in a couple of weeks, and then inflation news after that as well. Any thoughts on where that might go?
Well, obviously, it's never a dull moment. I think that we're recognizing that certainly the Bank of Canada is still moving in a direction, but maybe at a bit more measured pace in terms of cuts than we have seen over the past few cycles.
Right.
But I think beyond that, we're going to see how low can they go with a U.S. environment where it's much more stuck because the inflation progress, as we saw last week, has really stalled out. And so the question is, how decoupled, how much further? I think we would expect some further movement from the Canadian, from the BOC, but how much further can they go?
Okay, that's great. And Bobby, I'd love to turn things back to you to close us off. You also cover industrials.
That's right.
Can you just define for our audience what does industrials mean, and then what have you been seeing over the last few weeks?
Yeah, so generally the industrial sector would be companies that are selling products to other businesses, so business to business, with the exception of the airline sector in Canada. So the major Canadian airline, they are classified as a Canadian industrial, Air Canada. So it's a hodgepodge. In Canada, it's heavily weighted towards transportation because we've got the two big railroads, two very large cap stocks, and they're in a way ground zero for the trade and tariff debate, given how much of their revenue moves cross-border. So from a stock performance perspective, it has been more challenging for the industrials subsector in Canada, just given that it is ground zero for the tariff debate in a way. But again, we're trying to look at what could the earnings be 6, 12, 24 months from now and look through the near-term tariff noise to the extent we believe there aren't going to be longer-term impacts. It can create an opportunity. But again, just given that they're ground zero for some of the tariff impacts, there has been a pretty big impact on the industrials subsector performance this year.
Okay, thank you. Well, thank you both for joining me today.
Yeah, thanks Kyle.
Great. So next we'll be looking at a clip from earlier this month. On February 5th, Fidelity Connect's webcast, we welcome Steve Verhoel, Canada's former chief trade negotiator from 2017 to 2021. Steve was responsible for negotiating Canada's most important trade deals, including the new NAFTA, or USMCA, and the Canada-European Union Trade Agreement. In this clip, Steve shares how Canada should approach deal-making with the current U.S. administration. Enjoy.
What would you like to sort of flag to investors? Everyone's, a little bit caught up in this and feels like we're probably at the very early innings of a very long conversation. Your steady hand as a negotiator, what would you advise people in the markets and just anyone in Canada to just kind of hold on to for the next little bit here?
Well, I think that we have to accept that there's going to be continued uncertainty with respect to our relationship with the U.S. President Trump is a president that's going to be fairly volatile, fairly unpredictable, and we're going to have to just accept that that's the pattern we're going to have to face during his the tenure of his administration. So we've got to get used to that. But I think Canada has many fundamentals, whether it's on the autos side, we talked about electric vehicles, whether it's on critical minerals, our key resources on energy, gas, electricity. We've got a lot of very positive fundamentals, and it's a matter of whether or not we can convince the U.S. to try to move towards a more North American approach to many of these economic issues, rather than have the U.S. try to go it alone. And that will be the key indicator of what kind of success we can have. Whether we can reach that kind of understanding with the U.S. that we're far better off working together, which I think is clear, or whether the U.S. is going to impose further barriers and we have to start exploring other markets. That will be a key pivot point that we will have to be watching for in the months ahead.
Wise words there from someone who has been at the negotiating table before. So next we'll hear from portfolio manager Ramona Prasad, who touches on using volatility as an opportunity. Ramona joined us on February 4th, the day after the initial tariff reprieve, and she's a global investor who focuses on cheap valuations. So we'll hear how she seeks out the ideal holdings for her funds, which includes managing Fidelity US Dividend Fund and the equities sub-portfolio of Global Dividend and Global Monthly Income, among others.
You can get a measure of anti-correlation if you are able to invest across the entire world. So you're not just tied into one market driven by one thing, such as, say, the US in the last few years driven by glamour tech. So last year, as I mentioned, France got interesting for a moment, but in that moment, you can add a whole lot of stock at cheap valuations. And then Japan got really interesting for like one night. And last couple of years, it's just a question of hunting dispersion. So right now, an example of really interesting dispersion that opened up even more yesterday is what I call US versus ex-US. So everything outside of the US. And if you look at that valuation difference measured over a long period of time, today it is greater than 2 standard deviations versus its historical level, which is really big. So when stuff starts to move beyond 1 standard deviation and starts to approach 2, it gets really interesting. So that's been very good alpha signal to me to sort of reinforce what we see bottom up if you look stock by stock. So there are all kinds of examples. If you look at sort of multi-industrials that are based in Europe versus similar businesses in the US, big valuation differences. Consumer stocks in Europe, bank stocks in Europe versus similar in the US, big valuation differences. In healthcare stocks, even though they're all very cheap. So I've just been leaning into those valuation differences, understanding that with the kind of exogenous volatility that we're seeing, we might get an even wider spread, but often when we go beyond 2 standard deviations, you tend to get pretty good reversion in the decent amount.
So do you mind just giving us a picture, a visual of what you're doing when you're watching things get approaching 2 standard deviations? Are you rushing to your computer? Are you having a chat with your team? What actually are you doing? I'm kind of fascinated.
Well, honestly, what the day-by-day looks like is you are digesting a lot of research and to some extent meeting a lot of companies. There are times that it makes sense to talk to companies, and there are times like when you're in the middle of dislocation that it can actually not make sense to talk to companies. So for instance, last week on the Monday, when there was this panic over AI and pricing for a leading edge innovation, one of the suppliers, if you will, to the technology was actually in-house, which would have been a great meeting, but I'm sure the entire meeting was going to be focused on, is this real? And how much does this affect your business? And on the day of, the person who's come in can't actually say. So what everybody is looking for is reassurance, and what that CEO is very likely to provide is reassurance. That's probably not what you need. So most of my day ordinarily is spent figuring out which research and which access to companies is going to push my thinking as opposed to confirm my biases or confirm or comfort me, if you will. So I spend a lot of time trying to be very discerning about how I spend my time, if you will, and then a ton of time reading research from all over the world to figure out what it looks like from the bottom up. So I'm constantly just doing comparisons and essentially optimizations all around the world to figure out where the valuation differences are big enough so that you could lean into those differences and essentially get protected on your longer term return if the difference is widening.
Now, Ramona mentioned European companies in there, and as we've been focused on all of the news in North America, a lot has been happening in Europe too. On Tuesday, March 4th, we have another Upside webcast for you, focusing on politics and your wallet, helping you stay a step ahead. One of Tuesday's guests is Tom Stevenson, Fidelity International Investment Director and respected financial news writer, to share a global impact on the tariff discussion and update us on the latest with the European elections, an upcoming European Central Bank meeting, and looking at if Europe is Trump's next target or is Canada's next big trading partner. But to get our oil and liquefied natural gas to the coast, you need pipelines. And for more on energy trends in North America and the demand for Canada's resources, here is portfolio manager Joe Overdevest, who manages Fidelity Global Natural Resources Fund.
When you look at North America, we're definitely seeing electrification of the grid, more renewables, more data centers. For the most part, last 10 years, actual energy consumption of like utility energy consumption was probably flat. We became more efficient with light bulbs and other things that became more efficient. We didn't notice the world was kind of like needing more power, and now it's really taking off. We're going to need especially more gas. We're going to need more renewables, which will definitely draw natural gas from the US and from Canada, and also renewables. You're going to need everything, and you're seeing that nuclear is in need, gas is in need, renewables in need, and nuclear is definitely something that we can usually provide from Saskatchewan. So the resources that we have are definitely going to be in demand. We just have to make sure we're on the right page with our key trading partner as of right now, which is still the US.
And do we need to diversify as well, our trading partners? Because if we are building LNG terminals, ultimately those are usually sitting on the edge of places where you can send it across water.
Yes, and I think this is, again, we use the word galvanizing, or definitely centering now, probably Canadians going, wow, like, everyone's now up to the speed that like our biggest trading partner has a lot of leverage on us. And especially that we have not moved pipelines to other areas, especially to coast for LNG or for oil. Yes, we have LNG Canada, we have TMX. The audience probably has heard those. They're coming on right now this year, but they're just not a big deal. Like the actual grand scheme of things is still a very small percentage. We need more of that. Otherwise, yes, we are beholden to the US and beholden to whatever they want in terms of tariffs or other needs. So if we can get together, because it will take provinces to be agreeing. Many of these pipelines don't just go across one province, they go across multiple provinces to hit the coast. It would definitely strengthen our negotiating position next time we're in a situation like this. Hopefully never.
So hopefully never. Within the sort of discussion of interprovincial trade barriers being relaxed and partly put to bed, would pipelines come into that, or some version of a national project come into that? Would you like to see that as an investor? As an investor,
I think as an investor, yes. Even as a Canadian, generally, yes. Because usually these projects will provide taxes, will provide jobs, and as an investor, it just provides opportunities for our companies. If you just want to talk to the actual CEOs themselves, they would definitely want more, outlets. Just like any business person, you want to sell to one customer, or do you want to sell to multiple customers? Of course, you would want to sell to multiple customers, get the best price possible, and ensure, in particular for Canadians, that we have a stronger foothold for trade negotiations. Mm-hmm. But again, I think it has to come at a federal level to make sure all the provinces are on the same page.
So what is quant investing all about at Fidelity? Fidelity's Neil Constable is up next, speaking with host Glenn Davidson to talk about our special quant team and how the team is redefining the future of investing.
Remember, what everyone knows Fidelity for is a great active management shop. Our ability to outperform indices, add value over and above stated benchmarks, whether it's in equity or fixed income, has been building for decades. And active management is the act, if you will, of going out and finding information, processing that information, and doing a better job of connecting dots and making great investments on behalf of our customers than anyone else. And to the extent that that process is being influenced by quantitative techniques and data science and whatnot, it's not really about, are you a fundamental shop or a quant shop, right? We're an alpha shop. First and foremost, we're here to add alpha in our customers' portfolios. And as the world changes around us, we need to be constantly investing in what's the most relevant tools for the job, which is, by the way, not to say that we have any less dependence on our traditional core fundamental investment research process, which we've been building and nurturing for decades. Highly trained fundamental analysts that meet companies, think about how to connect the dots between the macroeconomy and individual company earnings prospects. That is an invaluable skill that forever will be part of what we do here at Fidelity. And what we're talking about now is augmenting that with all of the things that come with the data and technology that's now available, and we can use in ways that we couldn't use before.
So I mentioned off the top that February has seen a bit of market volatility, and in times of volatility, having a balanced and diversified portfolio can help smoothen the ride. Next, we'll hear from Etienne Jancas-Bouchard, Director, ETFs and Alternative Strategy, who answered a Fidelity Connect's audience question about the Fidelity All-in-One ETF suite of products, and when looking at a traditional 60-40 equity fixed income portfolio balance, does Fidelity plan on diversifying with alts? Take a look.
This question comes up a lot with Yuri and Timur talking about the 60-40, what's in it, what's in the 40 largely, and is that changing? So does Fidelity plan to diversify the 60-40 all-in-one ETFs with alts? Well, you kind of have a mix of those in there, don't you? But it depends on whether you've chosen conservative or balanced. But in any case, what's the alt mix, if at all?
Yeah, that's a great question. We don't really have any standalone alternative strategies in the all-in-ones right now. That's not to say that, we can't potentially looking at adding some in the future. Alts, I think, are a fascinating landscape. We're seeing, outstanding growth in the industry on that space. I think it's a great place to be looking for innovation. I think right now we're seeing a lot of innovation in that space. For now, no allocations, but we do have a bit of cryptocurrency, so we can consider that somewhat of an alternative asset class. So, for our, all-in-one balanced ETF, we're talking 59% equities, 39% bonds, and then 2% crypto. So that's, the way that we're approaching it for now. That's something that we saw as a great way to add diversification to the portfolio, and then, adjust our risk profile to be something neutral with regards to our main competitors, which are market cap-based index solutions.
So I just want to quickly go to your competitive peers beaten. We don't have a lot of time, but I wonder if you can just run through this. We'll put this slide up.
Oh yeah, it's a great slide to finish on.
It is.
It's my favorite slide. Highlighting the great performance that we've been able to get for investors. We've done an exceptional job, I think, of differentiating ourselves from our competitors. We're fairly unique in the sense that we don't have any passive other than Bitcoin. We have factor-based strategies on the equity side, but active fixed income, active small caps, and what it's led to is significant outperformance. We've, over the past 3 years, our balanced ETF, our all-in-one growth ETF, and this is at the end of last year, outperformed 100% of peers in the respective risk categories. And we don't have it on the slide here, but the conservative and equity mandate had their 3-year anniversary in January. Their 3-year number was also 100% peers beaten. So I think, so far we're very happy with the way that these portfolios have performed. We're not trying to take on excess risk. We're trying to do good stock selection, good asset allocation, and we're going to do that consistently. Like, we're not making any big tactical calls. These are strategically managed. You can expect diversification going forward.
So Etienne mentioned the Fidelity All-in-One ETFs. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. You can visit fidelity.ca/how-to-buy for more information. So do you want to lower how much taxes you owe this year and grow your investments tax-free? With all of the global politics news, it's easy to forget that Monday, March 3rd, is this year's RSP deadline. You still have a few days, and working with a financial advisor is the best investment you can make. So here is Fidelity Canada's Tax and Retirement Director, Michelle Monroe, for more on RRSPs and TFSAs.
Michelle, let's recap limits for 2025 for RRSPs and TFSAs.
So RRSPs, the contribution limit is based on earned income of the prior year. The maximum for 2025 is $32,490. Now, there's carry forward room if someone wasn't able to make their maximum. So the importance of going back and looking on what's on the prior year notice of reassessment or of assessment, going to the My Account online CRA.
Has each year's increase been predictable? Is it a consistent percentage increase?
I think it varies with inflation.
Okay.
But yeah, it
Makes
goes
sense.
up a little bit every year.
Okay.
Yeah. RSP contribution room is 60 days after year end, but falls on the weekend, so we have until March the 3rd. So we have an extra couple days there. TFSA contribution room 2025 is $7,000.
Which has been consistent, I think, for a couple
of years. Yeah. And somebody who's never contributed to a TFSA and say they were eligible since they were very first introduced in 2009, they could have the cumulative amount would be $102,000.
So next week, we'll continue bringing you commentary on how the potential tariff threats are impacting Americans. As I mentioned earlier, the European angle, and much more on how all of these headlines are impacting Canadians. With potential US tariffs on Canada and all of the other headlines, investing in the markets can feel scary, but it doesn't have to be. We hope you join us on Tuesday, March 4th and Thursday, March 6th for more from Fidelity's portfolio managers and experts on the latest in Canada-US relations, their long-term perspectives on the markets, and where they are finding opportunities to protect and grow people's hard-earned savings. Thanks for watching. And again, every clip you saw today is part of a full 30-minute Fidelity Connects video podcast, available on YouTube, Spotify, Apple Podcasts, and more. And for more from us, please keep an eye on Fidelity Canada's LinkedIn, YouTube, or Instagram. Thank you again for tuning in. I'm Kyle Sharapita.